Each one of us does not have the expertise or the time to build and manage an investment portfolio. There is an excellent alternative available and it is called as a mutual funds. A mutual fund is an investment intermediary by which people can pull their money and invest it according to the predetermined objective. Each investor of the mutual fund gets a share of the pool proportional to the initial investment that he makes. The capital of the mutual fund is divided into shares or units and investors get a number of units proportional to their investment. The investment objective of the mutual fund is always decided beforehand. Mutual funds invest in bonds, stocks, money market instruments, real estate, commodities, or other investment, or many times a combination of any of these. The details regarding the funds, policies, objectives, charges, services, etc. are all available in the fund's prospectus, and every investor should go through the prospect before investing in a mutual fund. The investment decisions for the pool capital are made by a fund manager. The fund manager decides what securities are to be bought and in what quantity. The value of units changes with change in aggregate value of the investment made by the mutual fund. The value of each share or unit of the mutual fund is called NAV. Different funds have different risk and reward profile. A mutual fund that invests in stocks is a greater risk investment than a mutual fund that invests in a government bonds. The value of stocks can go down, resulting in a loss for the investor, but money invested in bonds is safe. At the same time, the greater risk in stocks also present an opportunity for higher returns. Stocks can go up to any limit, but returns from government bonds are limited to the interest rate offered by the government. We have all heard the advantages of investing in a mutual fund over trying to pick individual stocks. First of all, mutual funds hire professional analysts that are market experts and devote many hours of study to various stocks. Unless you want to devote a large portion of your free time to the study of the financial reports, you probably won't have as much information to make a decision as a mutual fund manager. Then there is the well-documented advantage of diversification. Risk is reduced by holding several non-correlated investments. Put simply, some go up, some go down, and combined, the returns levels of the fluctuation or risk. Finally, the mutual fund offers smaller investors a chance to invest in small increments rather than having to save a large chunk of cash to purchase hundreds of shares of stock. Given the above advantages, it is no wonder that mutual funds have become a very popular form of investing. Now there are thousands of mutual funds to choose from, so how does one make a selection? Here are a few tips. Number 1. Do not be seduced to jump on the recently performing best fund. It may seem like the safe and rational thing to do, but like individual stocks, you want to buy low and sell high, not buy high and pray for more growth. Number 2. Even good funds may not be able to overcome the force of the overall market. You should be looking for funds that can exceed the broad market without increasing risk. Each fund has certain risk parameters that it is required to follow. Read the prospectus closely to understand what these are. Number 3. Limit the number of funds that you own. Unless you are trying to simply achieve the same returns as the broad market, diversifying into many mutual funds will not reduce your risk or increase your return by much. Number 4. Funds that become too popular or too big tend to slip in performance. There are several reasons for this. One final point to keep in mind is that the type of fund will totally depend on your investment objectives. There are certain funds that are designed for your objectives, be they retirement, income, growth, funding the kids, college, etc. If you found this video helpful, then like, share and subscribe this channel to get future videos.